Yeah, well, this is it's a philosophical question, Romaine, and I think this is the big question of the time because on one hand, the Fed is implementing monetary policy from a cyclical standpoint. The big challenge for investors to figure out with regards to 26 and beyond is will the Fed Reserve be operating monetary policy from a structural framework? In our view, we think that the risk of them transitioning to a structural framework is actually quite high because if you think about their too tight monetary policy and the impact that it's had on the economy over the last few years, essentially the Fed's reluctance to support this fiscal dominance regime has contributed to all sorts of adverse negative consequences from a K-shaped economy perspective in the economy. And so it's our view that one of those five people that you put up on the screen is going to have to lead the institution to structural regime change.
Yeah, it's going to be fascinating, of course, to see how that horse race actually shapes out. You take a look at reporting. It seems like Scott Bessent wants to get Donald Trump a list by Thanksgiving, and maybe we'll get a decision soon after that. But let's talk about, the leadership of the next Fed and what they'll be dealing with. Because you think about where we're headed when it comes to inflation. You haven't seen a lot of what we're talking about when it comes through with tariffs really show up in a meaningful way when it comes to the inflation data. Then you think about the labor market. You are starting to see some wobbles there. And certainly you think about some of the layoff announcements that we're getting from companies. Amazon just today, Reuters reporting. It seems like, again, the two sides of their mandate here could be in conflict. And I wonder how you're thinking through that, especially when it comes to how you put together a portfolio.
Oh, that's a fantastic question, Katie. And in our view, that we've been operating in this U-shaped economy framework, which gives the Fed a very robust window in which to ease monetary policy. They're getting a green light from the labor market and a green light from a structural regime change perspective to actually, bring this institution to the 21st century, if you will. And so it's our view, as it relates to constructing portfolios, you have to be maximum risk on at this juncture, because in our view, we think the Federal Reserve is going to go from, I would say, not understanding the impact that their balance sheet and their policy is having on the economy in terms of creating these K-shaped outcomes to agreeing to understanding that and actually making changes. And in our view, that's incredibly bullish.
Maximum risk on, Darius. Explain to us a little bit more what that looks like when you get down to the sector level.
Yeah, that's a great question. So on the sector side of things, whenever you're max risk on, you want to be in high beta cyclicals from a factor risk perspective and a sector risk perspective. So obviously that's a continuation of what's been working. If you think about the technology sector, communication sector, the AI trade should work. The one thing I will say is if you're an institutional investor, earmuffs if you're a retail investor, but if you're an institutional investor and you have to pick factors, there's likely to be a significant factor rotation at some point in the next, let's call it 3 to 6 months, as we transition from a weak economy that is, given the Fed a window in which to ease monetary policy to transitioning to an economy to a much more robust outlook. I'll throw one stat at you before I wrap up is if you look at the median or the mean of the 2026 and 2027 real GDP growth estimates among Bloomberg consensus, your guys, the Wall Street consensus, it's 1.9%. In our opinion, that number is about 100 basis points too low. And so we think there's a significant positive revision cycle ahead of us still from this starting point.
All right, Darius, great to get some time with you.